what we're going to do today in day 2, we're basically going to look at taxes. We'll see how far we get and how quickly it goes. What we're going to do is we're going to look at account types versus different investment vehicles, which vehicle to use when, taxes, RRSPs, TFSA, non-registered, compare and contrast, and then we're going to look at the tax table. So it's mostly going to be about taxes. If we do that really quickly, we can keep going, in which case we're going to look at personal finance, basically mortgages, credit scores, consumer debt, pensions, and scams and things like that. Okay. Let me bring up the chat so I can see if anybody has any questions. Anything from Tuesday that anybody wants to discuss or ask about or anything like that? Everything fairly clear? Okay. Sounds good. Okay. All right, why don't we begin? Maybe I'll do a quick run through just to sort of cover what we went through on Tuesday. So the purpose of these presentations to me is to get you guys interested in investing, get you into educating yourself, because after a few hours, obviously, you're not going to have all the information you might want to have. We're going to look at different asset types, and as we're going through, you should be looking to see, do I want to do it myself? Do I want to get a financial advisor? What types of assets do I want to do? Do I want to do real estate? Do I want to do exchange traded funds, mutual funds myself? Am I going to be doing small payments, small purchases, or big purchases? Am I going to be using TFSA, RRSP, what have you? So that's sort of the goal. And to give you information, I think, and to answer as many questions as possible. I am a long-term investor. This is not get rich quick. You're not gonna be a millionaire inside 6 months. That's just not what happens. It might happen to a few people, but there's way more people who lose all their money. Quick disclaimer, this is not investing advice. It's for educational, entertainment, demonstration purposes only. Please do your own research. It's also not a solicitation to buy or sell any securities. And a big thank you to the Neighborhood Small Grants, Vancouver Foundation, and Oak Avenue Neighborhood Hub Society, which gave me the money to cover the Zoom license, for example. So I do appreciate that. I am on YouTube, TikTok, and I have a CanadianMoneyTalk.ca website where I believe everybody's signed up anyways. So the glossary, I don't think I need to go over. We're going to be mostly looking at mutual funds, exchange traded funds, and then individual stocks. Real estate we'll get into next time, Tuesday next week. Bear market, bull market we covered, recession, depression we covered. Capitalization is the size of the company, so cap is usually, and you go over from 200 billion plus from mega all the way down to under 50 million, which is tiny. So we talked about stocks, which may have a commission to purchase depending on your brokerage. And you need to get several stocks to get some sort of diversification. I wouldn't recommend for people to start with individual stocks. ETFs are sort of a between mutual funds and stocks, in that ETFs trade like stocks, but you now do have diversification because they contain a bucket of assets. They do have an annual expense that the exchange traded fund company charges you. And they're usually passive, where they just follow some sort of a formula or an index or something like that. And mutual funds, there's two flavors, active and passive. The active ones have a significant expense ratio. You have the same diversification. There is usually a salesperson that sells you the active mutual funds, and they do get a commission for that. That is coming out of this expense ratio. They will very likely have a conflict of interest, and we'll look at that on Tuesday. For that ongoing commission, they should be providing a service, which I'll also cover on Tuesday. And then finally, we have mutual funds would just follow an index, so they're like an ETF in that sense, and they have a lower management expense ratio than the actively managed mutual fund. We talked about risk, where risk is an indication of volatility. What you need to determine is, if you're running the portfolio yourself, is, are you able to just handle the risk both financially and psychologically? When do you need the money back? And what type of return do you need? Those four things will dictate what sort of assets you will be investing in. Because if you say, I'm going to panic if I start losing more than a couple of percentage points, then that indicates you need to be in lower risk assets. If you need the money back in, in 6 months, you will be in much less riskier assets than if you need the money back in 20 years. And if you need a 15% return annually, you will be in much riskier assets than if you need a 5% return. So there's a spectrum of assets that you go from, all the way from cash through to a lottery ticket. Okay, so there you go. The closer to home, it's usually considered less risky. US probably still counts as home. Bigger companies tend to be less volatile and less risky than smaller companies. There's a few exceptions, but not to delve into that too much. We talked about target date funds, which if you don't want to make adjustments as the time of withdrawal nears into lower risk, target date funds will do it for you automatically behind the scenes, but they'll probably charge you a slightly higher MER. We talked about having an emergency fund, which is a good idea for anybody, investor or not, and then having some cash as dry powder in order to buy more assets if they go down. That, of course, sort of means you're timing the market. We talked about a bucket portfolio strategy, which is sort of splitting your assets into three buckets, where a bucket one is 2 years of living expenses of cash, and that prevents you from having to sell stocks or whatever you had that just went down, to sell the volatile stuff that went down. And bucket three is the volatile stuff, and that is going to make sure that you outperform inflation, that you beat inflation and you stay ahead of it. So that's the bucket portfolio. It's a great idea for retirees to be organized that way. And for everybody else, it sort of illustrates how different asset types work and how you may want to use them. So we went over different types of assets and what they look like over 60 plus years. And the more volatile stuff outperforms the less volatile stuff. There's a correlation between volatility and return. If you can stomach the volatility, then you can invest in higher return assets. And I differentiated between what I consider an investment, a speculation, and outright gambling. That is sort of my own personal view of the world, which you can form your own. It's important to start early to let time and compound interest do the heavy lifting. And it is also important to have or have an eye on fees, but ultimately you're looking for total return. If something is low fee but poor performer, that's still not doing you any good, just that you're saving on fees. Markets go up in the long run. There's a lot more green than red. The bull markets always last longer than the bear markets. We're in the middle of a bear market right now. It's never pleasant. It's just part of investing in stocks. If that's not something that you think you can handle, you need to be in, let's say, real estate, or you need to be in bonds, which have lower returns, but also lower volatility. People tend to be their own worst enemies by jumping in and out of things and selling high and other way, buying high because of the FOMO, fear of missing out, and selling low because of fear. So whatever study they did here, the average investor is significantly underperforming just an index, which is why I say, if you don't find this fascinating, just buy an ETF every month and you're done. You're good. Okay. Over time, the markets go up. And so the longer time frame you have, I can blow this up actually. The longer a time frame you have, the less risk you have, because there's very few even 10-year periods where the stock market is negative. But if you're only holding for 1 year, it's close to 50-50 that year is going to be negative. So time is something you need to look out for. And we looked at the different strategies. Lump sum, you put in a significant amount of money, whatever that is, and you do it once. Typical investor does a dollar cost averaging strategy, where they buy the same assets monthly for the same amount of money each time, and therefore they end up, if the market goes down, purchasing more shares. It's typically for people who are earning the money as they're putting it in. So Landon's asking, did the previous graph show that emerging market ETFs will outperform US ETFs? No, the green is green is stocks, blue is bonds, and the gray is 50-50 portfolio. The stocks would be S&P 500 Shiller Composite. So basically S&P 500 US stocks. Oh, the one below that? Oh, here we are. Okay. Emerging markets will, yeah. I mean, this is for 2002 to 2021. That's, I mean, by 0.5%. Emerging markets haven't done particularly well for me, but let's see what they saw as emerging markets. REITs, emerging markets is MSCI, which just means Morgan Stanley Capital Investments, I guess. Emerging markets, whatever the index is, and then the S&P 500. So yeah, they're roughly the same. Lately, I would have thought emerging markets were underperforming the US, maybe for the last 10 years, but prior to that, because this is 19 years, prior to that, perhaps they were better. Yeah. Okay. So dollar cost averaging, we covered. Generally, if you have the money, statistics show put it all in because you have a rising market, and therefore you make a profit this high. While if you do dollar cost averaging, your first profit is this high, your next one is shorter and shorter and shorter and shorter. So if you have the money, generally lump sum will win out over dollar cost averaging. Having said that, if you have bad timing, like I put in a whole bunch of money just before the 2008 crash, so it is what it is. It's better to do lump sum. And then what you want to do is every 6 to 12 months, depending on how eager beaver you are, rebalancing, where if you were doing, let's say, a 60-40 portfolio where you put 60% of the money into an ETF that was stocks and then 40% into bonds. After 12 months, those will be different. They might be 70-30, they might be 50-50. What you do is you sell off the one that was disproportionately high, and then you buy with that money the one that's disproportionately low. That way you end up taking some risk off the table, say, and you also, for your portfolio, you're selling high and you're buying low. Should you rebalance in a down market? Aren't you locking in losses? Well, in a down market, if you have money, put it in, but you're locking in losses, but you're using the proceeds in order to buy stuff that went down even more, if you think of it that way. So it's about proportions as far as rebalancing. Ideally, if you have the money, do put it in. But if if you were 60-40 and then the stocks went down and now you were 30-70, where the bonds held their value and the stocks fell, you would want to sell off the bonds, which maybe went down some, maybe even went up a tiny bit or held their value, and use the proceeds there to buy the cheap stocks. The idea with, let's say, a 60-40 portfolio is that they're not correlated. So if the down market with the stocks, if it went down, your other assets didn't, right? Actually, this is the first time in about 20 years that both bonds and stocks went down. Usually only one will, but because the interest rates went up, the bonds took a hit, and so even the bonds went down, but typically the bonds will hold their value and you can use them to buy the stocks that sold off. But yeah, good question. If everything went down, then you have to hold on or come up with more money. And we said, be sort of contrarian, be fearful when others are greedy when others are fearful. Good old Uncle Warren. Don't do hot stock tips. You're unlikely to outperform the market. So if you don't enjoy the analysis, then just buy an ETF that follows an index and you're good. Some people will do 80% of their portfolio will be ETFs, and then 20% are going to be individual stocks, for example, that they want to play with. So when markets go down, selling is usually the worst thing. Most financial advisors will say just do nothing. Ideally, you would be buying more. And you make most of your money in a bear market. It just feels really bad at the time because you're like, geez, I mean, it just really doesn't feel good to be buying then. And I told you my strategy for the market, that I don't think I can time it. And so I stay invested at all times. If the markets drop, I'll borrow to invest. Okay. Okay, so new stuff for today. So account types versus investment vehicles. I sort of put together this table where you have investment vehicles, so cash, mutual funds, stocks, ETFs, private equity, real estate, and so on, and then account types. Because I would ask people, so what kind of investments do you have? And they would tell me they have RRSPs, which is not an investment, it's an account. And that's sort of what prompted me to create this table. So you can actually hold a surprising set of stuff in the various Canadian accounts. The only one that was sort of a no was that apparently you can't hold real estate directly in a TFSA. You can hold REITs, real estate investment trusts. Who knew that there's an RDSP, a registered disability savings plan? That I only found out about that like a few years ago. Up until then, it doesn't really come up because it's not that common. Anyways, so do note that in an RRSP, you're not allowed to hold businesses where you have more than 10% ownership. Precious metals that are not gold or silver, so you can hold gold and silver in an RRSP. Commodity futures, private holding companies or private foreign corps. You're not able to hold your own debt, and personal property are non-qualified. Otherwise, everything seems to be fair game in an RRSP and RIF. Most people just will do mutual funds or stocks or ETFs, but okay. Which vehicle to use when? So if you're doing lump sum, you can do ETFs or stock because they're going to be they'll just have that trading commission if your brokerage does charge a trading commission. If you're doing small monthly purchases and you're doing a couple $100, make sure there's no commission, because that will be a really high percentage of the investment. So mutual funds typically are no commission. Brokerages will have ETFs that you can buy without paying a commission. And if you go to like Wealthsimple, there's no commission for stocks or ETFs, but then they don't do mutual funds. So kind of, as I said early on, kind of have a plan, know what you're going to be doing, and according to that, choose a brokerage and create your strategy. Okay, taxes and account types. So here we go. I hope everybody's awake. This is, I think, quite important. There's a saying, don't let the tail wag the dog. So I've sort of converted it to, don't let the tax tail wag the investment dog. What I mean by that is, don't let the taxation determine what you're going to invest in. Invest in good investments and then pay the taxes. However, I think if you're going to be saving for retirement and you're going to be putting money in for the next 20, 30 years, do it in the appropriate accounts. Make sure you know which ones are good to use when, and kind of stick to it. So that's sort of the point of this presentation. Depending on your tax bracket, you could be paying 30%, even more on your gains, and that ends up being a significant drag. So okay, so here we go. RRSPs first, right? Canadian staple, around since I think the 70s. RRSPs are bought with pre-tax dollars, or it lowers your income, or it gives you a tax refund. When I first started getting educated about this, that always confused me. Like, what do you mean about pre-tax dollars? But I'm getting a tax refund. Like, what do you mean? So I sort of did the illustration here. So this is the pre-tax dollars. So you have income, 60,000, you make a purchase, $10,000, adjusted income is 50. And you pay taxes on the 50, 30%. I just used a very flat rate. So that's the 15,000 of 30% of 50. And so your take home is 35. So I bought the RRSPs with pre-tax dollars. I didn't pay taxes on that $10,000. That's one version. Take home is 35,000. Next one is lowers my income. You could just say, well, my income's now 50. I'm paying 15,000 in taxes, take home 35. It means exactly the same thing. This is the tax refund. So you're using after-tax dollars for the purchase. So then you're getting a tax refund. So your income, 60,000, you're paying same 30% to make it simple. 18,000 is your taxes, take home is 42. You purchase 10,000, so cash left is 32. Your tax refund from the RRSP purchase at a 30% tax rate. So 30% times the 10,000 purchase, 32 plus the refund, you're back at 35. So it all works out the same. So no matter how people say it, it all works out the same. Just to prevent confusion. Maybe everybody knew. So the strategy is typically, and I'm not an accountant, so please talk to your tax specialist. You would want to use RRSPs heavily at the top of your career or in a high tax bracket to lower your taxes. Okay, so what I mean by that is, and I have a diagram for this in a second. If you are in a high tax bracket for you, like if you're like, I'm not going to make any more money other than maybe some cost of living increases, then RRSPs would be your vehicle at that point. If you think you're going to be making more money later, you know, you're going to climb the corporate ladder or what have you, then RRSPs are maybe not your ideal vehicle, or don't max them out yet and save some of the RRSP room for later. So the other reason you would use RRSPs is for tax inefficient investments. So, okay, I'm going to do some scrolling here. I've done this presentation umpteen times. I can never find a good way to organize this. So this is the illustration. So this is earnings on the vertical axis, and this is time. So the red line is your typical income. You're fresh out of school, your income goes up, you're climbing the corporate ladder, and then, like I said, at some point you're gonna max out somewhere. Okay, and then when you retire, you you drop in your income. So at the beginning, when you're in a low tax bracket or in a low tax bracket for you, TFSA is actually the preferred vehicle, because you're not going to get a big bang, a good bang for your RRSP buck, because you are in the low tax bracket. And TFSA, which I'll get into in a second, is bought with after-tax money. And when you're in the low tax bracket, you're not paying very much taxes in order to get that after-tax money. Okay. But then as you start making more money and as you start plateauing, TFSA is still valid. There's no problem, but now you're paying more taxes in order to get that after-tax dollar, and RRSPs will give you a nice tax deduction at that point. Okay. Some people say use RRSPs if you're making over 50K. I think you can be a little bit more sophisticated about it and say, yeah, I think I'm sort of plateauing. This is when I should really be pumping in the RRSPs. If your employer has a matching plan and the only plan they have it available in is RRSPs, do RRSPs. It's free money. Now, the other part of this chart is that once you retire and you stop working cold turkey, you should start withdrawing, obviously to live on. You have to be in a lower tax bracket to be withdrawing RRSPs than when you put it in. If you're withdrawing RRSPs when you're in a higher tax bracket, that when you put the money into the RRSP, it really ruins the whole concept of it. I mean, if you need the money, you need the money. I'm just saying it's intended to be income in retirement when you're supposed to be in a lower tax bracket. In retirement, most people are, but maybe not initially, because maybe initially you want to do a lot of traveling and you're spending a lot of money. Later on, once you sort of things cool down for you, then kids are out of the house, mortgage is paid off, you're not earning as much money, obviously, so you should be in a lower tax bracket at that point. Okay, so back to RRSPs. So that's what I meant, top of your career or in a high tax bracket to lower your taxes. Now, anything that comes out of an RRSP is taxed fully, meaning in the worst way. It's taxed as salary and as wages, and I'll show you the tax table. So if you have tax inefficient investments, and these would be investments that pay interest or foreign dividends are taxed as a salary and wages as well, then you would want to have those in an RRSP, because anything that comes out of the RRSP is taxed fully anyway. So that's usually how you do it. Okay. You have to be, I'm going to repeat this again, you have to be in a lower tax bracket when you're pulling money out of the RRSP than when you were buying them. RRSPs will let the money that's inside it grow until you pull the money out of the RRSP. Somebody had asked this previously. If you sell something within the RRSP, but you don't pull the money into your checking account, there's no tax implication at all. But as soon as you pull the money out of the RRSP into your checking account, that's when it gets taxed as if you had earned salary. Which I guess is fair, because when you bought it, you got a tax deduction off of your salary. So limits are used up when you're transferring money in. Now, some people don't know this. You can actually buy an RRSP this year to start the compounding, but you can use the tax benefit later. So if you have some cash now, but you're not working very much and you're not earning very much money, but you think it's a good time to buy and you have that cash, you can buy the RRSP. It starts the compounding, but next year when you're back and working again and you're in a higher tax bracket, that's when you can use the tax benefit. You can delay it. Okay. Any questions about RRSPs? Everybody's fairly familiar. Any? Okay. Moving on. So TFSA tax. Oh, how long can we delay the RRSPs? I don't think there's a limit. I don't believe there's a limit. I'll check on that. Obviously, you're paying more taxes by not using the RRSP deduction, so the government's okay with it that way. I don't think there's a limit, but I'll check. Okay, so TFSA, tax-free savings account. The S in that, the savings, that's a terrible misnomer. It's an investment account. I think you need to start withdrawing them at 71. Okay, yeah, so a little bit more information about RRSPs. So you can pull money out of an RRSP anytime you want. There might be some sort of a like your brokerage might charge you something for pulling money out of the RRSP. What you're thinking of, Landon, is that at 71, you're forced to convert the RRSP to a RIF. At that point, you cannot contribute anymore to an RRSP. And once you have a RIF, there's a schedule of you having to withdraw. At 71, you have to pull 5% of your RRSP's value out in that year. When you get to 88, you have to pull out 10% a year. And once you convert to a RIF, there's a small tax benefit. There's like some $2,000 benefit in taxes. I'm not that familiar with it. So some people will convert to a RIF earlier. If you convert to a RIF at 60, then you're forced to pull like 2% a year, and you do get that tax benefit each year, like I mentioned. So some people will do it for that, and yeah, exactly. Yeah, you have to convert to a RIF at 71, but you can do it earlier, so you get that tax benefit, and you're forced to start pulling money out. But I mean, it's small amounts. I mean, even at 71, 5%, unless you have $1 million in your RRSP, like it's not a big amount of money. And yeah, so since we're going into it, there's a concept of an RRSP meltdown. So if you have a lot in your RRSP, you could think of it as a tax liability, because as you're forced to withdraw it, it might raise you into a higher tax bracket. And so as a result, people who have, let's say, $500,000 or more in their RRSP, they might convert them to a RIF at 60 in order to spread it out over a longer period of time, over more tax years. Especially people who really don't want their old age security clawed back, because if you make over, I believe, around 80 grand these days, then they start clawing back. Okay, I'm going to get to that in a second. They start clawing back your old age security. I mean, it's not a huge amount of money, but some people, it's like, I've been paying my taxes my whole life, I want to get my old age security. CPP, they won't claw back because that you paid into, but old age security is paid by the taxpayers. So, that's a strategy that you can, there's actually specialists who work on that. Accountants should help you. Excel spreadsheet might help you as well. Okay, so question was, or should you quit your job so you are in the lower tax bracket while you melt down RSP before 71? Yeah, I mean, that's a complicated question. So the question is, should you quit your job so you are in a lower tax bracket when you melt down the RSP before 71? That will definitely put you into a lower tax bracket. You certainly live off your RRSP, but the question is, how much do you dislike or like your job? I guess that would be a major factor. And then the second thing would be, if you quit your job and then you're just living off the 50, 60 grand that you're pulling each year, from age 60 to 71, you're going to be in a super low tax bracket, but your total return, your total income, as a result, will be lower, right? The way the tax brackets work, if you make $1 extra, you'll still get to keep some. You might give half of it to the government, but you still get to keep some. So if you love your job and you still want to do the RRSP meltdown, you can keep working, pay higher taxes, but you'll still end up with more money than if you quit the job. You know what I mean? So, I mean, that's a personal decision as well, right? At 60, maybe you've had enough and you're like, yeah, that sounds great. So there's a lot of financial advisors and accountants will say, keep the tax deferral, meaning letting the investments in the RSP compound without paying taxes on them, keep that going as long as possible. And so they'll say, start withdrawing it at 71 when you have to. And others say, well, my income is like this, and then at 71, it spikes and I lose my old age security and I'm suddenly in a much higher tax bracket. So that's why they start the meltdown earlier. Okay. There's whole articles and books written about these strategies, and I mean, it's very different for everybody. Cool. Okay, so tax-free savings account, it's an investment account. Anybody who just has it as a savings account is wasting a ton of potential. So as I showed you, TFSA you might consider using when you're starting your career, when you're still in a low tax bracket, because it's not efficient to use up your RRSP room at that point. And low taxes make it cheap to get the after-tax money to put into the TFSA. TFSA is bought with after-tax dollars. There's no tax benefits upfront, as there are with an RRSP. But on the plus side, anything withdrawn is tax-free. And what's cool is when you actually withdraw it, there's one caveat about the tax-free thing, which I'll mention in a second. What's cool when you withdraw it is that the limit recycles the following year, which an RRSP does not. If you pull the money out, it's gone. So people will also use a TFSA for tax inefficient investments because stuff is tax-free in there, or for long shots, meaning, I think this is gonna go times 100 for me, and I don't know an investment that I would want to buy that I think that about. And so Bitcoin in 10 years ago, for example, if you put that into your RRSP, you have a millions of tax-free money that you can pull out. So that's sort of the idea. Okay. Next is the non-registered or cash account. This is super confusing because in your brokerage you also have cash. This is an account that doesn't have any tax benefits, basically. Okay, so it's non-registered. Registered really just means that there's some sort of a tax benefit usually. So you might also want to use a non-registered account if you're starting your career. Your TFA has been exhausted. I would generally start off with the TFSA before going into non-registered. And if you're still in a low tax bracket, because it's still not efficient to be using up RRSP room. The same thing, low taxes make it cheap to get the after-tax money when you're at the beginning of your career. If you've exhausted the TFSA and RRSP and you still have money, then a non-registered account is great, because that's the only thing you have left. It's also bought with after-tax dollars, no tax benefit upfront when you invest in this account. Anything withdrawn is taxed for capital gains. So how far are we? Okay. So when I show you the tax tables, capital gains get taxed at half the rate as your salary or your wages. So I would consider that tax efficient. Any dividends that are paid by those assets will be taxed very low if they're Canadian eligible dividends, which I'll explain when we get to the tax table, through to very high, which would be foreign dividends, which are taxed like salary. And the one superpower that the non-registered account has is that you can use it to lower other non-registered gains. So if you have losses, you can offset gains, capital gains somewhere else with these losses. This is the tax loss selling season that happens in December. So the idea is, I've had an asset that made money. It could even be you sold real estate that went up in price. And then I had some stocks that went down and I don't think they're going to recover. So I'm going to sell them. I'm going to harvest the tax loss and I'm going to use that tax loss to offset that capital gain. The non-registered account is the only one that you can do that with. People don't really think about it, but if you lose money in your RRSP or you lose money in your TFSA, nobody's giving you anything for that. That's what you have. Whatever you pull out is you get taxed on with the RRSP or tax-free money with the TFSA. Okay. Any questions? I think I'm covering it fairly comprehensively, so I'm hoping this is making sense. Okay. Let me go to my favorite, the tax table. So I hope people have seen this. These are marginal tax rates that you're seeing here, meaning if you're already in this tax bracket, if you make $1 more, you're going to be paying this much on that dollar. This is not your average tax rate. Your average tax rate is always going to be lower, or in the first tax bracket, that is also your average tax rate. Okay. So this is combined federal, and I had to use a province, so I used my own. I updated it for 2022. And so here are the tax brackets. And so if you're making $250,000 in salary, if you make $1 more, you pay more than half of it in taxes. Okay. So the columns, super, super important. These 3 columns are only used for non-registered accounts. Other income, which catches everything else, interest, wages, salaries, and so on, you do not want to be in this column. So other income is taxed the highest and includes taxed on interest, withdrawn RRSPs, purchased RRSPs, and foreign dividends. Those all get taxed in the worst way. RRSPs, you get that benefit as well. Okay. So this is what I meant is when you're in a high tax bracket and you buy RRSPs. So if you're making, 140 grand and you buy 10,000 worth of RRSPs, you get roughly a $4,000 benefit. But if you're making 70,000 and you buy 10,000 worth of RRSPs, you only get a $2,800 benefit. So that's what I meant earlier. Okay. This caters to investors and it screws workers and savers, because if you're working salary, if you're working wages, this is where you get taxed. You buy RRSPs, this is where the RRSP comes off as well. Capital gains, as I said, was 50% of whatever you're in here. So whatever line you're on, capital gains is always going to be 50% of other income. Canadian dividends. So let's talk about these. So eligible. Eligible dividends are for a publicly traded company. So you can have an ETF of Canadian dividend aristocrats. Dividend aristocrats are defined as having increasing their dividends year after year. Those would be considered eligible dividends. They're publicly traded, based in Canada. There might be a few other things, and there's no comprehensive list, by the way, of Canadian eligible dividends. I really want to put one together and put it up on the website, but and then non-eligible dividends would be if you have a private corporation and you're paying yourself dividends as the owner, then that would be Canadian dividends, but non-eligible. So let's take a quick look here. In BC, you can make up to $50,000 only in Canadian eligible dividends, and you pay zero taxes. How the tax brackets work really roughly is you add up all your sources of income, and that determines your tax bracket. And then depending on where the income came from, you pay the marginal taxes. And if you made so much, then it drops down to the next lower one. Okay, so that's roughly how it works. So I have a whole bunch of Canadian stocks myself. So my thing is I'm collecting these bad boys. And so like I can make up to 100K, and I'm paying minimal taxes. Check your own province. This comes from taxtips.ca, I believe. You can get these tables. Actually, if you're fascinated with taxes, they've got so much information on there. Capital gains are not bad. Again, in BC, just for fun, once you're over 150, 60 grand, capital gains actually end up being lower than the Canadian eligible dividends. The non-eligible dividends are going to be higher in all cases, but salary is still going to trump them, unfortunately. Okay. So, okay. So let's get back to here. Okay. So just comparisons between the different accounts and notes. I probably covered most of these. Put any bonds into an RRSP or a TFSA. So why do that? Bonds, sorry for the scrolling, guys and gals. Bonds pay interest. So if you have it in a non-registered account, that interest is going to be taxed here. So put the bonds into an RRSP. The interest will accumulate and they'll grow tax-free, sorry, tax deferred. And when you pull it out of the RRSP, it will still get taxed here. So you get the tax benefit up front, the deduction, tax deferral, and then you pay the same amount of taxes. So TFSA would be the other thing. Bonds are tax inefficient because they pay interest. Put any foreign dividend payers into an RRSP. So when I said about the TFSA, that everything in there is coming out of it is tax-free, that is true. But foreign dividend payers will get charged on the dividends, will get charged a 15% withholding tax. Okay. So like you'll see it, I see it in my brokerage, you know, I get paid $50 from BMW, which is obviously based in Germany, so foreign dividend payer, and they would have pulled $750 off of it, and I just see it as a negative. So in an RRSP, that 15% withholding tax on dividend payouts is not charged because it's a retirement account. In a non-registered account, that's where I hold them because I don't have any RRSP room left. You can get, you'll get charged the 15%, but then you get a foreign tax credit at tax time. Do not hold them in a, don't hold foreign dividend payers in a TFSA because they will deduct it, but you won't get any credit for it and you can't get it back. Okay. So use a non-registered account if your TFSA is exhausted. Otherwise, use a TFSA. If you expect losses, where you can use the capital losses to offset the capital gain, you might want to use a non-registered. But if you're expecting losses, then why invest in it in the first place? TFSA will basically beat non-registered. Obviously, it has a limited amount that you can put in. But yeah, except for the losses, TFSA will beat non-registered. So Daryl's asking, can you move stocks from TFSA to RRSP without taking a hit? or you'd have to cash out TFSA, then put into RRSP. I don't see, yeah, there wouldn't be a hit because anything coming out of the TFSA is tax-free, whether your brokerage allows a direct transfer or whether you actually have to, you might be able to move it. Yeah, maybe not. Your brokerage might allow it, definitely not the other way. But from TFSA to RRSP, your brokerage might do it. They might make you sell it, pull out the cash, and then buy the same stuff in the RRSP. Yeah, but there wouldn't be a tax hit. I mean, there might be some trading commissions, possibly. So yeah, definitely not the other way though. So an RRSP from a tax point of view will beat the TFSA if you're selling in a lower tax bracket than when you're buying, because with an RRSP you got the tax benefit up front, and you'll pay less taxes on it later, so you get that tax benefit. Like I said, you'll get $4,000 right up front, in the example that I did in the tax table, and then you'll pay 2,800, so you get a bonus of $1,200. With a TFSA, you won't get anything, and you will have paid money. You'll have paid taxes on the money to begin with. So the comment is, I guess if it was dropping right now, it might be better to cash out stock and buy new stock into RRSP. Yeah, I suppose. If you're buying the same stock, I mean, other than the delay of a couple of days by the time stuff gets transferred around, I don't know if there'd be much there. From a tax point of view, TFSA and RRSP are equal if you're buying and selling the RRSP in the same tax bracket. If you're ignoring that the TFSA had to pay taxes early and the RRSP pays them later, so just time value of money. And TFSA will definitely beat the RRSP if you're selling the RRSP in a higher tax bracket than when you bought it. Like, that's just deadly. That's not how RRSPs are supposed to be used. Jason's asking what to do if you are in a highest tax bracket. Well, it's a nice problem to have. Seems like nothing is great except for capital gains, so invest in real estate. Well, no, because real estate actually, from a tax efficiency, the rent gets taxed here, gets taxed in the worst way. If you sell an investment property, then yeah, you pay on the difference between the purchase and the sale price, you pay these taxes. So from that perspective, yes, but stocks will be the same, right? If you buy stocks in a non-registered account, or American stocks, for example, which is sort of the thing that I'm trying to do. In the non-registered accounts, I try to have either Canadian dividend payers or stocks that don't pay dividends, foreign stocks that don't pay dividends, and therefore I'll sell them when they go up and I'll pay capital gains. But the rent with the real estate gets taxed here, so that's the bad part. Real estate investment, do you suggest taking oh yeah, the capital? I'm not the best one to talk about that. I know the capital cost allowance, is it? I'm not enough of an accountant. Like, I talk to my accountant and ask where should I be investing in and what kinds of accounts, and that the advice I'm sort of passing on to you that I got from my accountant. But as far as the nitty gritty of it, I'm not gonna be able to talk about the CCA with any information, unfortunately. Please see your accounting professional. Yeah. So yeah, even non-registered will beat an RRSP from a tax point of view if you're selling in a higher tax bracket than when you're buying, especially if you had capital gains. Uh, so so like to put stocks into an RRSP, yeah, you get the tax benefit up front, but when it goes up in value, you sell it, you pull the money out, you're paying twice as much taxes as if it were in a non-registered account. So yeah, you got the tax benefit up front, but then you have to be super careful to be in a lower tax bracket when you're pulling the money out. Otherwise, like, but you understand, right? Anything coming out of an RRSP is taxed harshly. Uh, so so be very careful about that. Students should be investing in a TFSA or non-registered. I mentioned that. So to summarize, RRSP would be interest-bearing investments and foreign dividend producing stocks. TFSA could be growth or, again, inefficient tax, highly taxable, let's say interest-bearing. Non-registered Canadian dividend payers, or possibly high volatility where you could have losses to use as a tax write-off. But I don't know why you would want to be investing in something where you're significantly expecting losses. So some advanced tax concepts, lock in capital gains when you're in a lower tax bracket if you can time it, right? Like you have stocks that have gone up for you, and then you have a year when you take a year off work and you're like, let's sell those stocks and get, pay the taxes on them when I'm in a lower tax bracket. You can buy them back immediately, by the way. If you still like the stocks and you think they'll go higher, you can lock in the gains and then start fresh here, but do it when you're in a low tax bracket. Withdraw RSPs in a year when you're in a low tax bracket. I think somebody had mentioned that. Capital loss selling to offset the capital gains in a non-registered account. You do have to wait 30 days to buy back the losing securities, by the way. Or I think you cannot buy the same ones 30 days ahead either. So you can buy a different security. You could buy a different ETF that holds essentially the same investments. So you could lock in the gains. So you could lock in the losses that way. Yeah, wash sale rule, exactly. You could lock in the losses that way, and then you're like, yeah, I think it'll go up from here, so you buy a different ETF. Okay, so we covered that. We covered the table. Okay, well, that was actually faster than I thought. We're about an hour in. Shall we keep going? Yeah, okay. Any questions? Like, did most people sort of know this stuff already? Did I give you a couple of things? Okay, all right. I'm hoping it's fairly comprehensive. Like there's a lot of people who haven't even seen the tax table, and they're kind of shocked how harshly salaries are taxed. Okay, yeah, so there's new info. Cool. Okay, so this is going to be personal finance kind of stuff. Okay, so mortgages. There's basically two flavors: a new tax table, but some strategies. But the strategies are awesome. Okay, cool. I'm glad I'm adding value. So there's two dimensions. You have variable mortgages, and then you have fixed mortgages. Variable means that it follows basically what the Bank of Canada is doing with its interest rates, while fixed is following the bond market. That's where it's getting the fixed rates from. It's bond market plus some sort of a markup from your bank. but they don't move. Once you start the mortgage, the fixed ones don't move while the variable do. You can still have a fixed payment, but different proportions of the payment will apply to the principal versus interest. Or you could actually have variable payment. As interest rates change, you end up paying more. People seem to hate that because of the change, I guess, and the variability. Some mortgages you can convert from variable and you can lock it into a fixed. And then the second dimension is open versus closed mortgages, where open means you can put money into it any time, which is sort of a line of credit. And then you have closed, where you might be able to double up your payments, or you might be able to put in an extra 10 or 20% on the anniversary, but you can't just put money in willy-nilly. So Daryl says, I like variable, but I'm never house poor, so I have money to handle the change. Okay, cool. That's a good situation to be in. Historically, variable rates seem to win out about 60% of the time. You're statistically better off most of the time to get variable, but 40% of the time, if rates spike, it was better. And like, we're in that situation now. Somebody who got a fixed mortgage at 2% a year ago is now, so happy, because if they had a variable rate mortgage, that would be significantly higher. Did I want to talk about trigger rate? I'm not so familiar with trigger rates. What else did I have here? Jason says, I was lucky I needed to renew my mortgage last year and I knew it was not going to go any lower. So I locked it in a okay, for 7 years. Okay, good for you.
If you want, I can mention what the trigger rate is.
Sure, go ahead.
If you have a variable mortgage with a fixed payment, there comes a point where if the amount you're paying is almost all interest and you're not paying down the mortgage at all, or if it becomes that you're paying all interest, then Bank of Canada says you can't do that. So you have to either change how much money you owe, which would lower your payments to not be in the trigger rate, or you would have to put a big lump sum payment down, or you'd have to convert it to a fixed. Basically, you can't be making payments that just pay interest and don't reduce the principal at all in Canada.
Right, because you'd never pay off the mortgage.
Right. So you have to be paying it down so much.
Okay. Yeah. I wonder how frequently that comes up. I mean,
I've been buying and selling places for 20 years. This is the first time I've seen people hitting the trigger rate.
Okay. Yeah.
So I think the last time was probably back in like the late 70s, early 80s, when the rates were up around 20.
Right. Yeah. Okay. So it hasn't come up for a bit.
Yeah, and that was my parents' time.
Yeah. Okay. Cool. Good to know. So you can generally break a mortgage. Depending on the institution, they'll usually charge you 3 months interest in order to get out of a mortgage and to refinance. So you can do the math on it. More sort of closer to where I'm at. Can you clarify open versus closed? For sure. So open would be that you can put additional money in anytime you want to. So, you have an extra $500, you can put it in. Lines of credit work like that. Lines of credit, you can pull money out, obviously, whenever you want to. With a mortgage, you cannot. But when you have extra money with an open mortgage, you can put it in, so you're paying down the principal faster. With a closed mortgage, that's not allowed. There will be, depending on the agreement, there will be times, usually on the anniversary, you can put in an extra 10, maybe 20%. Some mortgages and some institutions will let you double up your payments. So you've selected that you're going to pay every 2 weeks, $2,000, let's say, and they say, okay, well, you can pay every 2 weeks, $4,000. So you can do that. All these additional bells and whistles will cause you to be paying a higher interest rate. That's basically how it works. You end up paying for it. So these bells and whistles, make sure you need them, because you're definitely paying for them. Like, if you don't think you're ever going to have extra cash to throw in, get a closed mortgage and accumulate the cash if you do have some, for the anniversary. Like my parents, much as Daryl's, I think, ended up in the 80s. You know, they would borrow from friends and everybody they could for the anniversary to put in as much extra money as they could, because that really shortens the lifetime of the mortgage. So yeah, choose the bells and whistles that you need.
You actually want to get a good mortgage specialist for this sort of stuff, because everything is negotiable, whether it's open, whether it's closed, whether it's semi-open, how much you can pay down annually, can you double up payments, all kinds of bells and whistles, and it all, yeah, makes a huge difference. I actually got my last mortgage from a UK company because they gave me 20% down annually plus doubling my payments for a lower interest rate than any Canadian bank would give me for a closed.
Okay. Yeah.
So if you shop around, usually those big companies like Monster Mortgage or Dominion Lending can find stuff all over the place, and these guys are pretty good.
Sure. Yeah. A mortgage broker as well. You can see if you can get a better deal. Even tiny percentage differences will make a huge amount of difference over time. So definitely make sure you're getting the lowest rate, but it's doing what you need it to do. I think a lot of people just stay with their main bank, and they may not be getting the best rate. Sure, it's maybe convenient to make the payments and to transfer money in and so on, but if you can get a lower rate somewhere else or get it to do what you want it to do.
Yeah, the banks are going to give you just what they have available. A real brokerage will be able to find the best lender at that time, even if you're staying within Canada. Also, if anyone is getting a mortgage, Google collateral mortgage. It's a really sneaky, nasty thing that sometimes banks use to lock you into their bank, and it makes it harder for you to switch banks when the term is up and you have to renew.
Okay. Yeah. I remember at the notary, when I was getting the home equity line of credit on my condo, they did something that it says, oh, now it'll be a lot easier for you to get a mortgage or anything on the same place. Like, it'll cost less at the lawyers as well. So they do all sorts of things. So hold on. Open versus closed, we talked about. Why choose one or the other? Is open more costly? Yes. So as I mentioned, for any additional benefits, such as being able to put in extra money, which will shorten the life of the mortgage and cost the bank money as a result, they will charge you higher interest. Obviously, for really useful stuff like it being open, it might be, I'm making this up, it might be an extra 0.75% or 1%. For being able to double up your payments, they may charge nothing, like it's just included, and they don't have a mortgage that doesn't have that capability. So yeah, like, you can shop around, but really know what you want. So Landon says, will you be covering this next Zoom call? Probably not, Landon. Like if we're going through it now, I think for the third session, I'll probably still have enough material to, we'll probably give this another half hour, see how far we get. And now there's still going to be enough material for the to have a full session without going over this again. So, right. So, a question that I get frequently. Let's put that back. Do you pay off your mortgage or invest? So this is sort of asking, should I be borrowing to invest? Because by not paying off your mortgage, you're basically borrowing that amount. So some of the things you want to think about is what's the interest rate versus the return. So if you're putting money into ETFs, as you saw one of the earlier tables, you might get 8, 9, 10% a year. So what's the mortgage rate? If it's 2%, I would say, yeah, invest. If it's 6 or 7, where we're sort of headed now, I'd be like, ooh, so you get a risk-free return of 7% versus a volatile 10%. Like I would be going for paying off the mortgage at this point. Okay. Is the interest tax deductible? So if the mortgage is on an investment property, that is tax deductible. If it's on your primary residence, then it's not. So if I were to pay off a mortgage, I would choose the primary residence because that there you don't get the tax benefit. Also, in order to pay the interest on the primary residence, you're having to make more money in salary because of the taxes you have to pay on it. While with the tax deduction, the interest rate is actually what is the true rate on the investment property. The other things would be more personal. Are you comfortable with additional risk, such as investing and actually losing the money? So, you have an extra 10 grand. It's like, I'm going to pay off the mortgage. Oh, okay, I'll put it into the market. And then it becomes $9,000 and then it's $8,000. And you're like, oh my God, I could have paid 10 grand off the mortgage and instead I lost the money. So there's no guarantee that you're going to make money. So beware of that. And just in general, are you comfortable with debt? Like some people's like, nope, that has to be gone. While other people use debt as leverage, as getting additional returns. So it adds risks and it multiplies both positive returns and negative losses. So stuff to think about. The numbers are probably the easiest, but you personally, like if you can't sleep at night or if you're kicking yourself that the money that you put in went down, and you're feeling bad about yourself, then just pay down the mortgage. So anyways, I hope that makes sense. Okay, any insights about the Smith maneuver? Okay, excellent. So Smith maneuver is it's billed incorrectly that you're able to write off the interest on your primary residence mortgage. And that is not what the Smith maneuver is. That is very incorrect. What happens is you can get a mortgage that is combined with a line of credit. And as you're paying down, or just get a home equity line of credit like I have, for example. And as you pay down the mortgage principal, that principal becomes available to you in the line of credit, in the attached line of credit. The line of credit usually, or I would say almost always, is a higher interest than the mortgage itself, but it gives you access to money. And then if you go and you borrow to invest, and there's three things that have to be true for you to be able to write off the interest. You are borrowing to invest, you are buying something where you're expecting some sort of cash flow, whether rents, interest, or dividend. So you can't buy gold because there's no expectation of cash flow there, nor an empty property out in the boonies somewhere. But if you're buying a stock, if you're buying that pays dividends, or the CEO at some point said that they're thinking about paying dividends, or you're buying a rental property, you can write off the interest. And then the third thing is it cannot be, the money cannot be put into a registered account. So no TFSA, no RRSP. It has to be a non-registered account. Those are the three things for you to be able to write off the interest. And so as you pay down the mortgage, you're building up room in this line of credit, and then you can take that and you can buy, you know, an ETF that pays you dividends, and there then you can start writing off the interest on that line of credit. Note that the huge part of your house that you still owe money on, you're paying interest with no tax deduction there. It's only the part that you are borrowing to invest that that you're able to do that. You can have a line of credit that's not attached to real estate at all, and if you borrow to invest in something, you can write off the interest there. Okay, so yeah, good question. Smith maneuver. I mean, there's actual specialist accountants to help you with it. I mean, conceptually, it's fairly simple. It is a way to pump up your returns, like I said, much like borrowing to invest by not paying off your mortgage, because you're basically making money out of nothing, but make sure that you are actually making money. So when I'm borrowing to invest, I will make sure that I'm buying something that pays dividends that will cover the interest on that line of credit. The other nice thing is that those dividends will get taxed at a much lower rate than the interest gets deducted at. So something to keep in mind, that you also get a tax benefit from that. Then again, the dividends are probably paid every 3 months, while your bank will charge you interest every month. So there's the downside. Okay, good question. Any other questions before I go on? Okay, so credit score, another personal finance thing. What determines your credit score? There's 5 things. The weightings are the number of credit inquiries, only 10%. Are you shopping for credit? You're sort of supposed to try to do it within a 2-week period. That way you get dinged once. But if you're desperately looking for credit and you're looking all around and you're hitting all the banks, future creditors are kind of thinking, okay, this person's in trouble, and that you may not be as credit worthy as you look. Credit mix, another 10%. So not a huge thing here. So having different types of loans. Don't get a bunch of loans just to improve this. That's stupid. But you have a mortgage, you have a credit card, you have an auto loan, you have a personal unsecured line of credit. I'm sure I'm missing a couple, but by having different types of loans and being able to handle them, they give you a better score for that. Credit history, so that's the length / the age of your profile, 15%. Make sure you keep whatever credit lines and credit cards available. That's more in the don't lose them. Daryl's asking, is it possible to have a 900? You're getting ahead of me, Daryl. Is it? I believe it is. somebody on a podcast was bragging about having a perfect score. Um, in Canada, we are out of 900. Mine's 841. And that was updated a couple of days ago. I'm sure you can. If you churn credit cards, you close them, so best to keep oldest card. So churning credit cards and like moving money from one to another, for example, closing them. No, generally, okay. I mean, you want to be responsible, right? You don't want to have 20 credit cards going. Like I have 3. I use each one for a different purpose. And each time that I applied for one, my credit score dropped, which was the inquiry part here. No, I mean, not hugely, but it went down. If you are going to close a credit card, close the most recent one, keep the longest ones, but ideally don't open them in the first place and then hold on to them. I had a credit card for a long time and I just sort of didn't use it because it didn't give me any miles or any cash back. And then one day they sent me, oh, it's been closed. And I phoned it, hey, can you please reinstate it? Like I got all this history. And they're like, nope, sorry. And it was gone. So now I make sure I put at least one transaction on all 3 of my credit cards. A couple of them have automated payments on them anyways, and then the others I just make sure that once per month I use them. Like it won't go dormant for I believe a year, and then they'll close it on you, I think, after another year of non-usage. So if you are going to close the newest, but be judicious about it, right? Like don't have 20, just get a few. Anyways, so I think that makes sense. Ooh, okay, hold on. Daryl, I was told by American bank account that longest credit card makes a difference. So keep oldest card. Yeah, for sure, because it has the most history. My Canadian bank closed my oldest card a few years ago, but they didn't report it to the credit bureau, so it didn't ding me. I mean, I don't know when they closed it. I wasn't that interested. It was gone when they closed the one on me. I could have asked when they closed it, and I could have looked back at my credit history and seen if there was a drop. But I think I had that one for like 20 years. So by the way, the credit scores and all these weightings and so on, uh, how the credit bureaus, which is Equifax and TransUnion in Canada, we have 2 in US, they have a third one. How they make their money is by providing these scores to financial institutions, and each financial institution will want a slightly different version, different weighings, and each of these components might be a little bit different. So like the scores won't match up perfectly is sort of what I'm saying. Anyways, what's interesting is you want to keep the history, and in fact it's better to have bad history than to have no history. So somebody who has no credit at all is an unknown risk, and financial institutions hate that. They'd rather have somebody who's been consistently bad. They'll have a higher credit score than somebody who has no credit history at all. What's the biggest advantage of a high credit rate, high credit score? It's you'll qualify for mortgages, and you'll have better bargaining power, and you could talk them down in terms of rate, or you'll just get a better rate outright. So having a good credit score is important. Don't, like I said, don't get loans just to get a better credit score. Don't keep a balance on your credit card. Just like that doesn't help either, by the way. Pay everything off. So that's the payment history. Do you pay your bills on time? Like just basic stuff, right? A big one is credit utilization, which is 30% of your score. Use less than a third of your available credit, 30% roughly. Once you get over that, then your credit score goes down. Now, if you are utilizing zero of your credit, then they're basically not getting a very good idea about how you are about your credit. So that's not perfect either. But don't carry a balance and be paying 20%. Pay off your credit cards. That would be my suggestion. Daryl says, I like to use 20% of my credit card every month and pay it. Definitely pay it immediately. I don't know what limit you have. If you're using 20% of it, you might be a big spender. So no interest, but helps my credit score and keeps the card open. Definitely keep the card open, as we've said. Like my credit limit is like in, like minimum I think is 10 on one card, and I spend like $300 on it. So I'm nowhere near anywhere getting to the credit limit. Do check your free credit report. You can actually get them online before you have to mail them, so it costs you a stamp and a couple of photocopies. The form takes literally 3 minutes to fill out, but you can get a free credit report. I use Borrowell. It's a free site. They do send you the occasional spam, hey, you would qualify for this credit card kind of thing. But the screenshots I'm about to show you, or that I showed you, are from there. So look for accuracy and to discover identity theft. You don't want to discover that there's a problem with your credit after the bank declines your loan request. Like, keep on top of it. If there's a line of credit that you don't remember, then that might be an indication of identity theft. Okay. Daryl says, I buy everything gum bills. Yeah, me too. Many banks provide a link to free credit report. Sure, yeah. My Canadian one is from Scotia. Okay, perfect. So if your bank provides a credit score, great. And a credit report. The credit score is an easy number, but you want to go over your credit report every so often, make sure you recognize everything and make sure everything says paid on time, or whatever that version says. Because you're like, I paid all my bills on time. Why do I have a black mark on my credit report? The worst one is when somebody took out a mortgage in your name. That's the worst thing, because the money's gone and you're supposed to be paying it. So here's kind of what's impacting your score. Missed payments, credit utilization. I happen to be at 22%. Derogatory marks would be that late payment. I believe you have to be over 30 days late before this happens, but just pay on time so you're not paying the interest. Funny thing about credit cards, if you read the fine print, you get charged interest back to the day of the purchase, not to the due date of the payment, which a lot of people don't know. Credit reports absolutely can have mistakes on them. My name is fairly uncommon, but if you're John Smith, you could get mixed up with 100,000 other John Smiths. Average credit age, okay, total accounts, and here's the inquiries. So I think they go away after a certain amount of time, I believe a year. So do you have a good credit score? So this is for Canada. You should sort of be over 660, ideally over 713. I think as soon as you're kind of over 700, you're golden. So I mentioned this, that different institutions use different weighings. Average Canadian credit score is 672. So most Canadians are here. Some provinces average higher, some obviously average lower. So there you go. Okay, consumer debt, don't do it. Don't carry on your credit card. I got a new credit card application just today. And it's like everything is in the 20 percentages, like cash advances, late payments, everything. Just like, don't, just don't do it. What time do we have? Okay, so let's go till 8. Let's see how far we get. Okay, that's cool. So teaching kids, I don't have kids, so I'm probably not the best one to ask or talk to about this, but just what I've read, uh, I'll pass on quickly. Obviously, everybody will do it their own way. Communicate with them. Like I think kids are fascinated about anything, about life and anything with parents. And so it's like, hey, what are you doing? And like not letting your kids know about finances, about how much money you get paid. Um, it's you're keeping them in the dark. Uh, I remember my parents didn't teach me anything really about investing because they didn't know, and it just kind of keeps propagating it from generation to generation. So uh, learn it yourself and then be open with your kids. Hey, I lost my job. We're not able to make ends meet, you know, and just sort of keep them in the loop, I think. Share the information, tell them what you're doing and why. If you're into investing and trading stocks, let them look over your shoulder. Like, why not? Right? Time in the market makes it easier. Teach kids to start saving or help them get them started in their 20s, even earlier. I mean, first money exposure would be allowance, I would suppose, which you probably start very early. If they're older, start them now. So uh, if they're underage, I believe age of majority in most provinces is 18, I want to say. So you can create a trust trading account, and then stuff that they would be familiar with, Disney, Netflix, whatever they would know. Um, so if the thing is, there's something called an attribution rule, where as a parent you cannot open an account in your kid's name, and then give them money and then have them pay very low taxes because they're not making any other money. If the CRA catches you, that gets attributed back to you. However, if they have a paper route and you don't give them more money than they would, you know, uh, they would make in the paper route, then theoretically the CRA can't really say anything. So that would be something to look at. So Daryl's saying by started me, I meant actual investing for retirement, not just learning. Yeah, I mean, I think to a teenager, the concept of retirement is foreign. I don't know if they'd be on board, but if you say, hey, you can get started so you can buy a house like this, or just to start accumulating money. Yeah, if they start at 18, they could be financially independent by 40 for sure. Learning, I think, is the most important thing. I think if you teach them well, they'll start saving for their retirement and for financial independence uh, without you pushing them into it, I would say. Again, absolutely no experience with kids, so I know more about dogs than kids. So the other thing is, let's finish this. So one decision you'll need to make is whether to give allowance for chores, to be associating work with money, or whether you give them an allowance because they're kids, and then you live here, so you're expected to do chores and not associated, you'll have to make that call. And then get on the same page about the allowance that they get, about saving versus spending it versus gifting it. So if your family's into charities and so on, then that would sort of be the third bucket. And it's like, well, here's $10 and here's 2 for candy, here's 3 for saving, and here's the rest for charity. That sounds a little lopsided, but so that that's sort of a quick summary of all the articles that I've sort of read about this. Yeah, one thing I wanted to mention as well is there seems to be, just like with lottery winners, with kids that have been given money by their parents, but like significant amounts of money, they generally, because they didn't work for it, it usually ends poorly. It's the first generation that makes it, and then it's the second generation that spends it, and then they're down to zero again. So education, communication, and maybe just don't give them huge gifts. Uh, I remember Warren Buffett said that to his granddaughter, he was going to pay for her Harvard education, and then he was going to give her, I want to say, well, $1 million, which is enough to get a business started, but not to live off from the age of 20. So, yeah, you sort of have to make those decisions as well. But I think the biggest gift you can give to your kids is to teach them about investing and to get started early, and talk to them about financial independence. Again, retire early, to a teenager, they're like, yeah, I don't know what I'm going to do for the rest of my life, but it's not, like I want to do something with my life probably. So it all depends on the person, obviously. What I do want to do ultimately is to teach either adults, which I guess I'm effectively doing, but also with high school kids and college kids, because there's no education. The school system expects the parents to teach, and the parents generally don't know, and so they just ignore it, and they don't teach the kids anything either. So it's unfortunate, and it just propagates it, like I said. So uh obviously preaching to the choir here, you guys know more than the average Canadian, I'm sure. But like my parents didn't know anything. They had a financial advisor, and they didn't know what they were putting their money into, and it was all very safe. It had to be very safe. So term deposits were their favorite thing, Eastern European saving, and but not investing. So comment is, we didn't learn much about personal finance in school. Probably they want to keep us enslaved as worker bees. Okay, well, conspiracy theories aside, will there's rumors of bosses telling their employees, hey, you should get a new car, you should buy a big house. That way they get into debt and they have to keep working. I don't know if I agree with that. Jason's reading Rich Dad Poor Dad. Yeah, Rich Dad Poor Dad. It's actually one of the reading recommendations way at the end of my document here. And by the way, I did put a copy of it up on the education tab, as well as recording from Tuesday on YouTube. So I did put that up on the website. Yeah, I listened to Rich Dad Poor Dad, and actually a lot of his other stuff. Uh, yeah, he's got some good ideas. The whole language thing, I think he's probably going a little bit overboard. But um, the other thing is, he doesn't seem to be a big fan of the stock market, and he's all about real estate. but if you listen to him on YouTube now, he's about Bitcoin. So go figure. Yeah, it's one of the books. One of the books. The Millionaire Next Door was a good one as well. And there's quite a few. I think any education is better than none. But yeah, anything, including hopefully my seminars, encouraging people to get started. Okay, pensions at work. The two versions are defined benefit and defined contribution. I think a lot of people don't know which one they have or which one's which. Defined benefit is usually considered the better one. This is where your employer is putting money away for you, hopefully, and they will promise to pay you a certain amount per month. And obviously, the longer you've been there, the more per month they will pay you. So if you're there for 5 years, they won't pay you a heck of a lot. They might either, if you leave, they might pay you out a lump sum, or they'll lock it up for you in a lira till you're 55. The government typically has defined benefits. They've sort of died out in private, the private sector. They're all saying Robert Kiyosaki has people on his podcast that talk about stocks and other investments. He admits it's fine, just not something he knows a lot about. Okay. I've watched just him, and it seemed to be, he seemed to be pumping up, let's say, Bitcoin. He has a couple of good ideas, since we're back to Robert. He kind of says the two good things I kind of like is that he says assets is what makes you money and liabilities is what costs you money. A car, unless it's a taxi or an Uber, is not an asset, it's a liability. House where you're living, it's costing you money, it's a liability. I mean, an accountant will put it on the asset side of the balance sheet. You could argue that it's making you money by saving you rent, but I understand what he's saying. So that's a great way of thinking about things. A boat is definitely a liability. And then the other thing I like is that he defines your wealth by how many years you don't have to work, because you have a lot of people who make a lot of money and they spend it even quicker than they make it. And if they can't work, they're out on the street like within months. So that's not a wealthy person. And there's so many people who live hand to mouth. Obviously, financial independence is infinitely, you're infinitely wealthy because you could live forever off of your portfolio theoretically. So I do like those two concepts. Some of the other stuff, sure. Okay, so that's the defined benefit is no matter what the stock market does, your employer, usually the government, like I said, or a union job, is promising to pay you a certain amount per month. If it's a company that does this, and I'm thinking of Sears in the US, where they went bankrupt and everybody who had defined benefit pension plans had nothing. With government, obviously, it's not going to go bankrupt. So that's, that's a gold-plated one. Defined contribution is usually some sort of a matching scheme where they put some in, you put some in, they match you up until a certain amount. But when you get your statement, it says you have $50,000. And if the market goes down, then you'll have less. So you're taking all the risk, and their risk is very defined as far as how much they're contributing. So that way the risk is on you, while with the defined benefit, it's on the institution. Okay. Spam and scams. I was asked to add this. I think it's good for everybody to know. Online scams designed to get money, personal information, financial information, steal your identity, or to infect your computer. Phishing is when attacker contacts you pretending to be somebody you know, and they want you to give them personal information or to click on something or to open something. It looks like it's from a trusted sender, Amazon, what have you, usually urgent, and they want you to click on a link or especially open an attachment which will install malware, some sort of a virus, and you may see something happen, you may not, and it's tracking, your passwords and so on. And then you have tech support scams where you get a phone call, hey, your computer's infected with a virus. It's been a decade since those things started. And I cannot believe they're still phoning, which indicates that people are still biting on those things. I cannot believe it, because they would stop if if it wasn't working. Phone scams, scammers posing as a CRA, auto dialer posing as the CRA or border services phones you, and sometimes they just want you to press 1 on the phone and that starts charging you fees. They want your credit card number in various ways. I had a phone call where they said, we'll give you a 10% cash back card. We'll replace your current Visa or MasterCard and we'll give you 10%. And I'm like, yeah, that's not a thing. And the next step would have been that, hey, we'll cancel your credit cards for you. Can we have the numbers? So prevention, don't click on any links or open any attachments that you're not expecting. I know it's almost a reaction that people do that. Don't. Go to the site that you enter yourself, not by using a link that the email provided. So don't click on the email from Amazon. Go to amazon.ca and look at it there. Make sure you have your latest Windows update, your antivirus is up to date, have a firewall. Don't give personal information, my goodness, to a total stranger. Don't give your birthday, social insurance number, address, credit card information, bank account numbers, especially if somebody phones you. At least phone them back, but not to the number that they give you. Yeah, phone them, but look up their number. And government agencies don't send you emails or texts, and they don't phone you. Like, they will send you mail. Okay. That sounds like actually a good. So let's see here. So Daryl says, Jason, if they're giving you 4% to your 8%, then they are increasing your investment by 50%. No good investment will make you 50% returns. Yeah, the matching in these company, they're usually RRSPs. Unfortunately, they don't let you choose TFSA versus RRSP as per our previous conversation. If I was fresh out of university, I would want a TFSA, like I said. It's free money. It's part of your compensation. Absolutely take advantage of it. There's usually a max. So check out the investments that they have. They're usually not the best, at least in my experience. They usually do have high fees, like in terms of MERS on the mutual funds that are typically the vehicles. The high fees. So these accounts are usually run by a big bank, Fidelity, Manulife, whoever, and they will have a subset of their available investments. They will all be Fidelity, Manulife usually, depending on who creates that for your company. Your company's paying them significant amounts of money and probably covering some monthly fees for you as well. The high MERS, though, is what you want to check out, and you want to check out whether they're good quality mutual funds and they're actually outperforming their index and outperforming their the other mutual funds in the same category. If they're not, still go ahead with it, but only do enough to get the maximum match and then call it. If there are actually good investments available, then put in more than the minimum to get the match. Each company will be different. Like the big companies generally will pay the fees for you, and they'll pay for Fidelity or whoever it is to set up all of this stuff and administer it. So you shouldn't see those fees. The MERS, there will be. definitely take it. As Daryl says, yeah, if they're doubling your money, that's a free return. DE says, my understanding is match what employer gives. Yeah. The rest invest in low cost brokerage. Yeah, that's a good way to go. So yeah, just maximize the match, and then the rest you could do low cost brokerage, low cost ETFs. Um, that seems very reasonable. Like I said, if they happen to make available good investments, I think I've seen one where there were actual ETFs available. So, you could try going for those. But research the stuff on Morningstar, for example, before buying anything, and try to get good stuff. Okay. So good. Um, Sanjeet says, I transferred company RRSP into personal RRSP account, so no life company investment for me. Usually when you're working for the company, they don't let you transfer it out. If you're not working for them, they might let you transfer it out, or they might make you wait till you're 55 and it's locked in until then. So it just depends on how it's structured and on the company. Obviously nothing you can do about it. It's part of your compensation, so you take whatever you're given, and you play the game as best as you can. Training scams are everywhere too, Daryl says. Some are like you're offering here, but many are charging money. If it is a limited time offer, sign up in 7 days. I usually don't trust that. I've noticed all these sign up in 7 days, send me the offer again next month. Yeah. I mean, there are legitimate training companies out there, let's say, teach you to trade options, right? Teach you about real estate, how to make money in real estate, whatever it is. The courses are usually pretty expensive. There's so much information out there, some of it will dubious, but I mean, you can learn it yourself. The problem I have with a lot of training companies is that if you guys were able to make money at what you're teaching consistently, you would be doing that. You would have 200 traders sitting in a basement somewhere making money hand over fist. The fact that you cannot consistently make money at what you're going to teach me, and instead you're teaching, is making me think this isn't as foolproof as you're making it sound. So I kind of look at training. I mean, they're not scams. It's just that a lot of people maybe don't use it, or maybe it's questionable. Like, I mean, I have experience, and I've been able to make it work, and I'm happy to help other people. But I mean, if it's a company that has paid trainers, like, I guess they have to they have to pay them, and they have to have money coming in. A DE says some company plans let you transfer out one times free per year, otherwise 25. Okay. Otherwise $25 per transfer. Yeah, it depends on what sort of plan it is as well. Maybe some are a little bit more flexible. Usually when you're working there, I don't think you're able to do anything. Maybe you've run into a few where you can, so that's good. Daryl says, I go by the general rule. If it's too good to be true, it probably is. I think that's just have some critical thinking. The problem is I can totally see my mother, for example, who's in her late 70s, just pouncing on things that just sound really good, and I don't know if she has the critical thinking at her age that would sort of save her from some of these scams. Some of them are very obvious, like the one where they phone that you have a virus on your computer. Like, if I have time, I'll keep them on the phone for 20 minutes. So if I don't, I just hang up on them. But again, I'm shocked that they're still doing it, because it means it's working, which I find amazing that people haven't heard from it, because I get one every, well, maybe 1 or 2 months now, but previously it seemed like every second day I had one. So anyways, I think that's sort of a natural stopping point. We're 2 hours in. We're going to talk about insurance, life insurance and whole life, which is going to be a little spicy perhaps, because there's stuff. So Daryl says, I enjoy keeping scammers tied up. My record is 5 days. I have no words how you manage that, but good for you. I'm hoping it wasn't a single phone call. Because that sounds, it would be difficult even for you, not just them. But yeah, uh I don't know, like sometimes they sound like they're call centers, which I find, like, you go to work knowing that you're going to be lying to people. um Look up Jim Browning and Kid Boga on YouTube. Okay, I'll copy that. Um, so yeah, why don't we save life insurance for the third session? What I sort of got left, I think, is what I think is the most interesting parts: becoming financially independent, um, some portfolio examples, which you guys might be ahead of me. We'll talk about mutual funds and analyzing sort of what each of these things is. And I mean, I showed you this in the previous one. How to begin, and then I want to spend some time on alternative investments, real estate, private equity, startups, and stuff like that. And then this is a latest edition where I give a letter grade according to downside risk protection, appreciation, leverage, liquidity, control, cash flow, tax benefit, and inflation hedging for different types of investments, which I think will be useful. So Daryl says I use second line to get fake phone number, second WhatsApps. Oh, okay. Okay. Daryl, you've turned it into an art. Since I've stopped working, I've had more time on my hands, but I don't have that much time. So unless there's any other questions, I hope this has been useful. Everybody stayed awake through the everybody stayed awake through the tax part. Sanjeet says a real life example on how to do analysis on company to buy, such as, yeah. I'll do a YouTube video. Sanjeet is asking a real life example on how to do analysis on a company to buy, such qualitative and quantitative. I've done how to analyze a company previously. I think the video is something about value in investments. But I think you're looking at more from a slightly different angle. So I'll do that. And let's see. Jason says I put the fees I could find for the RRSP company plan. I put the fees I could find for the RRSP company plan, and it's from Canada Life. Sanji, you're most welcome. This has been really interesting. Thank you very much. Yeah, thanks, Daryl, also for contributing. I don't know if I can I grab this? Oh yeah. Okay. Whoop. It's a real life example. I've got a note for it's a PDF. Luciano, you're welcome. Yeah, and so the next one will be on Tuesday, 6 p.m. Pacific. The links are all in the same place. As soon as this processes, I will put it up on the in the same place in the education tab of the website, and you guys can review if you feel the need. So cool. Let me stop the sharing, and yeah, I will wish everybody a good evening, and have a good weekend as well. And we'll talk again on Tuesday. All right. Have a good night.